What's up, guys? Welcome to Crypt-Economy, and we've had the biggest interest rate increase or hike in the last 28 years. So the the Fed hike was done by 75 basis points, which has been the biggest since 1994. Now, of course, there are more things and in play kind of in the macroeconomic situation right now. But if you look at what's going on here, what was expected, let it's pretty straightforward. By the way, 75 basis points was expected automatically, and it was also expected because of the 8.6% number that came out a couple of weeks ago. And based on that, the markets have rallied a little bit, which is pretty cool, because this is an expected rate increase. So the market was actually pricing this rate increase in the losses that we saw in the past few days. And then we've got some relief rally here, because now people feel that there's no bad news, at least in the short term, for the next few days, if I may, right? And that's gotten us this teeny tiny bit of a rally, where we've seen Google going up by 2.86%, Apple up by 2%, Microsoft up by almost 3%, Nvidia up by 4.5%, Amazon up by almost 5.25 percentage point as well. Now this is pretty cool, and we are going to see energy mineral based companies going down pretty much because of the shortage of oil, as well as the rising prices for crude oil as well across the globe. And a lot of it has to do with the war, with the supply chain kind of being interrupted there as well. Now, if you look at what Fed's doing and what they are projecting to do to kind of counter this inflation or this rising inflation, here's what they're planning. And by the way, we are at 8.6% right now. If we look at just US, if we look at across the globe, we are looking at numbers close to 7.5, kind of 7.5% for India, around that same figure across the globe as well. However, with that being said, if you look at specific sectors like food, like energy, we are looking at inflation as high as 35-40% for certain things. So just to maybe give you an example, if you look at inflation as a whole, let's say majority of your stuff is food, or majority of your expense is food. If you were paying $1,000 last year per month, right now you could very well be paying $1,300. So that $300 could very well be your phone bill, your electricity, your utilities, all of those things. And at the same time, they could even maybe include your insurance and those payments. Now you have to arrange for all of that extra on top of your food expense. Now Fed is projecting a raise to about 3.4% by year end, which implies another 175 basis points of tightening this year, plus the QT that they're going to do. This is going to drag markets down quite a bit, because 175 basis points of impending rate hike across kind of 2022, or spread across 2022, is going to bring the markets down. People are not going to have enough money to actually invest into the markets. They're not going to have enough money for discretionary spends, because a lot of their expense now is going to go towards their loan repayments, right? Because those interest rates are rising. That becomes their first priority, to clear their loans, to clear their mortgages and all of those things. So that's going to drag the economy down, and as it drags the economy down, we are going to see more and more layoffs. We are looking at companies like Coinbase announcing 18% layoffs, Gemini 20%, and a lot of other companies. These are just the crypto firms. If you look at Robinhood, they are announcing layoffs as well. Twitter just, by the way, cancelled their annual trip to Disneyland. And yeah, that's kind of, they're killing happiness there, of course. So if you look at what central bankers are doing from an economic projection standpoint, everybody is against the Fed, more or less, and everybody's projecting that the Fed aiming for a soft landing is definitely not going to work. We are definitely going to have a bumpier touchdown, as Fed struggles with maybe even guessing or even calculating the right amount of inflation. Because for them, first it was a transitory thing, second then they said, oh, it's not going to be that much, right? And this is the highest inflation number that they've seen in the last 4 decades, and they said that nothing major, right? So they've kind of lost the ball here, and we are looking at the economy slowing down quite a bit. Now, if you look at yesterday's FOMC meeting, Fed Chair Powell, what he said was the consumer is in very good shape. Now, I just explained the inflation thing to you. The inflation is the highest in last 4 decades, and he says the consumer is in rather very good shape, right? Then he says there is no sign of a broader slowdown in the economy, and we have more than 35,000 people who lost their jobs in the last 1 month alone, and that's just United States. If you look at other countries, other major economies, even India, which usually is not as affected by a mass recession, at least in the past couple of recessions, we are looking at layoffs and a lot of companies closing down their businesses. So of course there is a broader slowdown in the economy. Not sure what these guys are looking at, or kind of maybe they're looking at newspapers from a couple of years ago. People are talking about it. Yeah, this is something that I wasn't really sure. Consumer confidence is low. Of course it is low. Definitely it is low. Stock prices are down to some extent. Yeah, we are down by quite a bit. Like, just maybe let me pull up what Amazon is doing, right? Let's look at Amazon. So stock prices are down to some extent, right? Now, what do we mean by some extent? Let's look at where Amazon is from 20th of November 2021. So that not that long ago. I'm looking at from an all-time high point. Amazon is down for almost 43%, and the bottom the local bottom that Amazon made was about 46%. And this is true for a lot of stocks. This is not just Amazon. I could very well pull up other stocks and you'll see the same thing. So this definitely does not make sense to me, at least. If you look at other companies, Starbucks and all that, everything is down more than 30, 35, 40%. This is strange. Yet the Fed does not see a broad slowdown. Right? And this is not just the US stocks. This is across the board. This is Indian stocks. This is all the indices. Let me just maybe pull up something pretty cool for you guys. Let's look at the Australian index. Right? Australian index is trailing down as well. Looking at Indian companies, same thing as well. The markets are being dragged down. This is India right now. Right? These are the biggest companies. Look at the finance sector. Look at what's happening in the market right now. If I just open up the top 50 companies in India, it's pretty much the same thing. 2%, 1.5%, 1.25%, 1.3% in the financial sector. Non-energy minerals, energy minerals, 2.5% to 3%. So the indices are being dragged down quite a bit, be it India, be it United States, be it any index for that matter. And we are looking at kind of a broader market slowdown here. Now, what can we do, right? And what's the state of crypto in all of this? Of course, crypto saw a little bit of a relief rally as well from our support range of about $20,000. It's an important support. So about $19,200 to $20,000 is a good support for Bitcoin, followed by about $16,500 to $17,500. Now, given that the current state of economy is not really great, and given that we are going to see more rate hikes throughout the year, there is a definite possibility that we see Bitcoin losing more steam across kind of the next few months. So we might see some accumulation phases, and then we'll see a slow drag down. And we are looking at the volume again right now, and it's starting to decrease. And when the volume decreases, we see more volatility in the markets, be it Bitcoin, be it stock market. So definitely 16.5, 17.5 range looks very probable to me, at least. And Ethereum has been weakening quite a bit, especially due to the Celsius debacle, due to the ST ETH versus ETH debacle. Right now, if I open USDD has lost its peg. So we were for USDD, we were trading at 0.96 US dollars instead of $1 that it should technically be. We'll give them some leeway. 0.99 is also great, but that's not what they were trading at yesterday. And that's after Tron Foundation has been putting in millions, hundreds of millions of dollars to possibly try and maintain that peg. So there's a lot of stuff happening in the market. There's a lot of whale manipulation happening in the crypto markets as well, where people are trying, or rather whales are trying to liquidate, let's say, Celsius. It does feel so. If they actually liquidate Celsius, we are looking at very, very stringent regulations coming up for the next cycle. We are looking at probably the market, or rather this cycle being the last cycle without any stringent regulations in crypto. And we are already, by the way, looking at a lot of regulatory marks or regulatory remarks coming out for stable coins, especially for algorithmic stable coins. A lot of people now don't trust algorithmic stable coins as well. So we are yet to have a recession. Now, what are we looking at? What are we looking at for the next couple of months? So first of all, 28th of July is when we are expected to have an update on what happened with the second quarter GDP. Now, the Fed does say that we've seen some relief, but looking at the economy and looking at the businesses and their results that are coming out, I don't think so. I think there is a big chance that the second quarter, it's going to be very difficult, by the way, to prevent a recession right now. The second quarter of this year is most probably going to be in a negative GDP growth as well. And once that happens, we are in a fundamental recession. Because right now, if you look at S&P, we are already, by the way, down more than 20% from the local top, and that means technically we are in a recession already, or we are in a bear market already from S&P 500 standpoint, but we are not fundamentally in a recession yet, or at least until the GDP numbers come out, and they are kind of more on the negative side, or they are expected to be more on the negative side. And even by the way, even a 0.05% in the minus is a negative number, is a recessionary number. And given the amount of leverage in the markets right now, given the amount of leverage in the crypto markets right now, it's going to be a volatile season. It's going to be a volatile cycle, and probably it's going to be a very, very harsh, or kind of one of the harshest recession phases that we have seen in a long time, just because of the amount of free money that's been available to a lot of people in the market. The ease of making money has gone up quite a bit, and that kind of brings down a lot of people, that brings down a lot of companies possibly. Now, how should we be navigating all of this? Of course, if you are an SIP person, if you're looking at a 10-year standpoint, then things are pretty cool for you, right? This is a good time to SIP because you get to accumulate more units, be it Bitcoin, be it specific stocks, be it Amazon, Microsoft, Google, Apple. These are strong companies that are going to do well now. Of course, because they are tech companies, they've seen a lot of downside. They've seen much higher downside than, let's say, consumer staples, or even if I compare it to consumer discretionary. So for example, Starbucks, this is something Starbucks is a place where you go to when you have extra funds, right? When you have extra savings. So you've had that, or people have had that, and we've seen the growth of Starbucks. But as their savings have started to decline, we've seen kind of less, or we are going to see rather even lower revenues coming out of Starbucks. So we're going to see some downfall in terms of business results, and that's going to bring the stock price down. And it's usually a great time to DCA, great time to let your SIP continue. So one of the most important things that we can do in these markets is build an emergency fund, have 3 to 6 months worth of expenses saved in your bank as cash. I know cash is definitely something, given the high inflation, cash is a very dangerous thing. But then for an emergency fund, it's the best thing. You might want to keep it into, let's say, a high interest savings account if you may, but that's cool. Just keep it handy. And then number 2 is don't let your SIPs stop. So depending on if you buy into specific stocks every single week, every single month, that's completely your call. However you do it, just don't let them stop throughout this time, because you've been doing SIP in a higher priced market, and now it's very important to do an SIP, or to rather continue the same SIP in a lower priced market, so you can get more units in the same amount of money that you've been deploying earlier. And that averages out the volatility in your portfolio. So it's a great time to SIP, in my opinion, or rather to continue your SIP. So you need to make sure that you don't lose your job. You need to make sure that you upskill yourself. It's an important thing to do. It's an important thing to learn new skills that are going to benefit the business or the company that you are working in right now. What that will do is it might end up making sure that you don't get fired or you don't get caught up in the layoff. So you need to be an A player and save more money and keep your investments going. This is the best time to do an SIP or to continue your SIP, in my opinion. Of course, not financial advice. You need to take your own financial advice and not from random people on YouTube. That's it, guys. This is today's video. Hope this gives you some insight into what's going on in the markets. If it does, make sure to smash that like button and don't forget to subscribe, guys. I'll see you guys next time.